Those who read this letter will be the most successful people today. I will be the one to provide you with knowledge, experience, and wealth. Most importantly, from this point forward, I will help you memorize the lessons of success in the shortest time possible. Share me with your friends so that together, we can become elite and build lasting wealth.
The truth is, most people misunderstand this. They gaze upon the flashing red and green tickers of Wall Street and see a casino, a playground for the lucky, or a battlefield for the ruthless. But they are looking at a mirage that hides the most dangerous psychological arena ever constructed by human hands. The stock market is not a mechanism for printing money, it is a mechanism for transferring wealth from the impatient to the patient, from the emotional to the disciplined, and from the dreamer to the realist. In the smoky aftermath of the great crash of 1929, amidst the rubble of shattered fortunes and suicides, one man stood amidst the debris not with a prayer, but with a slide rule and a philosophy so counterintuitive it felt like heresy. Benjamin Graham, the Dean of Wall Street, did not write The Intelligent Investor to teach you how to beat the market, he wrote it to save you from yourself. This is not a story about numbers, it is a story about character. It is the archetypal journey of the intelligent investor, a stoic warrior who walks through the fires of financial panic without being burned, and who resists the siren song of euphoria without losing his soul. The narrative begins in the deep, dark recesses of the human mind, where the twin demons of fear and greed wage an eternal war for control of your financial destiny. Most fail not because they lack intelligence, but because they lack the temperament to disobey their own biology. The story opens with the definition of the enemy. Graham draws a line in the sand that is as sharp as a razor, separating the investor from the speculator. The speculator is the archetype of the gambler, the man who buys a stock not because he understands the business, but because he believes the price will go up tomorrow. He is obsessed with timing, trying to predict the unpredictable swings of the market's mood. He reads charts like tea leaves, looking for patterns in the chaos, driven by the adrenaline of the bet. He is the man who looks at the price of a tulip bulb or a .com share and says, "This time is different," but the sensational reality is that it is never different. The speculator is destined for ruin because he is playing a game where the odds are mathematically stacked against him by his own emotions. Contrast this with the archetype of the intelligent investor. This figure does not buy a ticker symbol, he buys a piece of a business. He approaches the market not as a casino, but as a grocery store. When the price of hamburger meat goes up, he weeps. When it goes down, he rejoices and buys in bulk. The investor demands three things before he parts with a single dime: thorough analysis, safety of principle, and adequate return. This is the triad of survival. If an operation does not meet these criteria, it is not an investment, it is a gamble with your life savings. The psychological analysis of this distinction reveals the illusion of prediction. We are wired to believe that we can foresee the future, that we can outsmart the herd. Graham shatters this ego-driven fantasy. He posits that the future of security prices is never predictable. The investor, therefore, does not profit from prophecy, he profits from protection. He builds a fortress around his capital so strong that even if the world goes mad, his financial soul remains intact. The lesson here is the death of the ego. To be an intelligent investor, you must admit that you know nothing about what the market will do next week. You must surrender the need to be right about the asterisk direction of the wind and focus instead on the asterisk strength of your sails. As the narrative deepens, we encounter the silent thief that stalks every portfolio: inflation. In the early chapters, Graham paints a terrifying picture of the erosion of purchasing power. The archetypal saver, who buries his money in a mattress or keeps it all in safe bonds, is revealed to be a victim of a slow-motion robbery. The dollar you hold today will be worth pennies tomorrow. The sensational truth is that safety is relative. Cash is safe from volatility, but it is vulnerable to decay. Stocks are vulnerable to volatility, but they are the only shield against the long-term corrosion of inflation. The intelligent investor must therefore venture into the volatility of the stock market not out of greed, but out of necessity. He must become an owner of enterprises to protect his labor from becoming worthless. This creates a dramatic tension in the investor's heart, the fear of losing money in a crash versus the certainty of losing purchasing power in a bank account. To navigate this, Graham introduces the concept of asset allocation, the art of balancing the aggressive sword of stocks with the defensive shield of bonds. The story then introduces the two primary avatars of the intelligent investor, the defensive investor, and the enterprising investor. The defensive investor is the archetype of the prudent guardian. He knows he has limited time and perhaps limited interest in the granular details of finance. His goal is freedom from worry. He creates a permanent autopilot portfolio, often splitting his capital 50-50 between high-grade bonds and a diversified list of leading common stocks. His strategy is sensational in its boredom. When the stock market rises and his stock allocation swells to 55%, he sells the excess and buys bonds to get back to 50%. When the market crashes and his stocks fall to 45%, he sells bonds to buy cheap stocks. This simple mechanical act, rebalancing, forces him to do the one thing human nature hates: buy low and sell high. He acts against the scream of the crowd. He is the calm captain in the storm, adjusting his rudder while passengers panic. The analysis here reveals the power of humility. The defensive investor wins not by being smarter than the market, but by being more disciplined than the speculator. He accepts average returns to achieve above-average peace of mind. On the other side of the spectrum stands the enterprising investor. This is the archetype of the active hunter. He is willing to treat investing as a business. He digs through the dustbins of the market, looking for the cigar butts, companies that are ugly, unloved, and beaten down, but still have one good puff of value left in them. He looks for bargain issues, stocks selling for less than their net working capital, essentially buying a dollar bill for 50 cents. But Graham warns with sensational intensity: the path of the enterprising investor is physically and mentally grueling. It is not for the faint of heart. It requires the patience of a saint and the courage of a lion. Most who attempt this path fail because they mistake their ambition for ability. They buy the glamour stocks, the high-flying tech companies with zero earnings but infinite hype, thinking they are being enterprising, but they are merely being seduced. The true enterprising investor avoids the growth stock trap, companies priced for perfection, because if they stumble even slightly, the fall is catastrophic. Instead, he hunts in the shadows, buying the boring, the neglected, and the distressed. Then, from the mists of Wall Street folklore, emerges the most vivid and important character in the entire book, Mr. Market. Imagine you are in business with a partner named Mr. Market. He is a man of extreme psychological instability. Every day, without fail, Mr. Market knocks on your office door or calls you on the phone to name a price at which he is willing to buy your interest in the business or sell you his. The catch is that Mr. Market is a manic depressive. Some days, he is euphoric, he sees only sunshine and rainbows, and he names a price for the business that is ridiculously high. On other days, he is despondent, he sees only storm clouds and ruin, and he names a price that is absurdly low. The sensational twist is that Mr. Market does not care if you ignore him. He will be back tomorrow with a new price. The speculator allows Mr. Market to be his master. He lets Mr. Market's mood dictate his own value. If Mr. Market is depressed and drops the price, the speculator panics and sells. If Mr. Market is manic and raises the price, the speculator gets greedy and buys. But the intelligent investor treats Mr. Market as a servant. He realizes that Mr. Market's pocketbook is deep, but his brain is shallow. The investor looks at the price Mr. Market offers and compares it to his own calculation of intrinsic value. If Mr. Market offers a price way above value, the investor gladly sells to him. If Mr. Market offers a price way below value, the investor thanks him and buys from him. And if Mr. Market's price is reasonable, the investor simply ignores him and goes fishing. The psychological depth of this allegory is profound. It separates price from value. Price is what you pay, value is what you get. The market is a voting machine in the short run, tallying the votes of fear and greed, but a weighing machine in the long run, measuring the substance of the business. The lesson is emotional sovereignty. You cannot control the market. but you can control your reaction to it. The intelligent investor is the one who can watch his portfolio drop by 30% and not feel a flutter of panic. Because he knows that the quotation is just Mr. Market having a bad day, not a reflection of the business's actual health. The narrative momentum builds as Graham attacks the cult of the new era. In every bull market, the siren song rises, the old rules no longer apply. This is a new economy. Profits don't matter, growth matters. Graham, with the weary eyes of a historian, sees this for what it is, a recurring delusion. He takes the reader on a tour of historical crashes, showing how the blue-chip darlings of one era become the bankrupt corpses of the next. He dissects the psychology of the IPO, initial public offering, calling it, "It's probably overpriced," or "imaginary profits only." He reveals that investment bankers are not your friends, they are salesmen trying to unload merchandise at the highest possible price. The intelligent investor treats every IPO with extreme suspicion, knowing that they are usually sold at the peak of a bull market when the public's resistance is lowest. The analysis here focuses on cyclical awareness. The market moves in pendulums, swinging from unsustainable optimism to unjustified pessimism. The intelligent investor does not try to predict the asterisk timing of the swing, but he always knows where the pendulum is. When the world is shouting, buy, he checks his wallet. When the world is shouting, sell, he opens his checkbook. The first segment concludes with the establishment of the investor's internal constitution. Before he buys a single stock, he must look in the mirror. Can he handle the isolation? Can he stand alone when the experts on TV are telling him he is wrong? Graham posits that investment is most intelligent when it is most businesslike. You are not buying a lottery ticket, you are buying a share of a grocery store, a car factory, a pharmaceutical lab. If the stock market closed for 5 years, would you be happy holding what you own? If the answer is no, you are speculating. The intelligent investor is a business analyst, not a ticker watcher. He focuses on the dividends, the cash the business pays him for his ownership, rather than the capital gains, the hope that someone else will pay more for the stock later. The dividend is the bird in the hand, the capital gain is the two in the bush. By focusing on the steady stream of income, the investor frees himself from the tyranny of the daily price. As we stand on the precipice of the next section, the foundation has been laid. The intelligent investor is a defensive warrior, armed with the shield of asset allocation and the sword of valuation, protected by the armor of emotional discipline, and facing the chaotic, manic-depressive giant known as Mr. Market. But how does one actually select the specific stocks that will survive the storm? How does one find the margin of safety that guarantees survival when the bridge collapses? The story is about to descend from the high peaks of philosophy into the gritty trenches of financial analysis, where the real work of fortune building begins. The air is thick with the dust of balance sheets and the scent of undervalued assets waiting to be discovered by the one who knows where to look. The narrative now descends into the engine room of the intelligent investor, where the philosophical mist clears to reveal the cold, hard steel of the margin of safety. We are overlooking the most important thing. The secret of sound investment can be distilled into these 3 words. Imagine a bridge builder who constructs a span to support a maximum load of 30,000 pounds. He does not then allow a truck weighing 29,000 pounds to cross it. He limits the load to 10,000 pounds. The 20,000 pound gap is not a waste, it is the margin of safety that guarantees survival when the unexpected happens, when the wind howls, the materials degrade, or the load is heavier than declared. Benjamin Graham reveals that the stock market is a bridge that often collapses. The speculator drives a truck weighing exactly what the bridge can hold, betting on perfect conditions. The intelligent investor drives a light car, knowing that even if the bridge is weak, he will make it to the other side. This is the archetype of the pessimistic optimist. He is optimistic about the long-term growth of the economy, but deeply pessimistic about the short-term accuracy of his own calculations. He buys a stock not when it is fairly priced, but when it is priced so cheaply that even if the company falters, he will not lose his shirt. The analysis of this concept reveals the arithmetics of survival. If you pay $1 for a stock that you calculate is worth $1, you have no margin of safety. You must be perfectly right. But if you pay 50 cents for that same stock, you can be wrong about the growth, wrong about the management, and wrong about the economy, and still make a profit. This is the sensational discount of the doomsday. The intelligent investor is a hunter of discounted dollars. He looks for companies that have fallen into temporary disfavor, perhaps due to a bad quarter, a scandal, or a general market panic. The crowd sees a broken company, the investor sees a broken stock. He buys the assets, the factories, the land, the cash in the bank, for less than it would cost to build them from scratch. He is buying the business for free. The psychological depth of this strategy is that it removes the need for clairvoyance. You don't need to predict the future if you buy the present for half price. The story then shifts to the checklist of the defensive investor. Graham provides a rigid set of criteria, a suit of armor designed to protect the passive investor from the arrows of misfortune. The defensive investor does not buy just any stock, he buys only those that pass the 7 tests of quality. First, adequate size, he avoids small, volatile companies that can be blown away by a stiff breeze. Second, strong financial condition, he demands that current assets act as a fortress, twice as large as current liabilities. Third, earnings stability, the company must have some earnings for the past 10 years, no red ink is allowed. Fourth, dividend record, the company must have paid a dividend without interruption for 20 years. This is the sensation of reliability. A company can fake earnings, but it cannot fake the cash it sends to shareholders. Fifth, earnings growth, a moderate increase in profits over the past decade. Sixth, moderate P/E ratio, the price should not be more than 15 times the average earnings. And seventh, moderate ratio of price to assets, the price should not be more than 1.5 times the book value. This checklist acts as a mechanical gatekeeper. It strips away the emotion of the story and forces the investor to look at the naked numbers. The speculator falls in love with the narrative, the revolutionary technology, the charismatic CEO. The defensive investor ignores the story and measures the foundation. If the stock does not pass the 7 tests, it is rejected, no matter how exciting it sounds. This discipline creates a portfolio of lead soldiers, boring, sturdy, and reliable. They may not double in a month, but they will not vanish in a crash. The lesson here is the elimination of unforced errors. In tennis, the amateur wins by keeping the ball in play, not by hitting spectacular winners. The defensive investor wins by not losing. But for the enterprising investor, the one willing to treat investing as a full-time profession, the narrative takes a darker, more aggressive turn. He enters the junkyard of Wall Street. He is looking for the net stocks, a concept so sensational it seems illegal. A net is a company whose stock price is lower than its net current assets, cash, inventory, and receivables minus all debt. Essentially, the market is giving you the factories, the brand, and the machinery for free, and actually paying you to take the company. This is the cigar butt strategy. The company might be ugly, it might be dying, but if you buy it for less than its liquidation value, you cannot lose. When the company is eventually liquidated or bought out, the value is unlocked. The enterprising investor is a scavenger of value, finding gold in the wreckage that the growth investors have left behind. He also hunts for special situations, mergers, spin-offs, and reorganizations, where the uncertainty of the event creates a temporary mispricing. He profits from the chaos of corporate change. The narrative intensity builds as Graham redefines the concept of risk. The academic world and Wall Street define risk as volatility, beta, how much a stock price bounces up and down. Graham calls this nonsense. The archetypal, intelligent investor understands that price fluctuation is not risk, it is opportunity. Real risk is the permanent loss of capital. If a stock drops 50% but the business remains sound, the volatility has increased, but the risk has actually decreased because the stock is now safer to buy at the lower price. The speculator sees a dropping price as a red flag of danger. The investor sees a dropping price as a green light of safety. This inversion of logic is the hardest psychological hurdle to cross. It requires the investor to divorce his emotions from the ticker tape. He must realize that the market is there to serve him, not to instruct him. The quotation is a convenience, not a verdict. The story flows into the dilemma of the fund industry. Graham, with prophetic vision, warns against the illusion of superiority sold by mutual funds. He points out that the average fund manager, burdened by high fees and the need to follow the herd, cannot beat the market average over the long term. The archetypal fund manager is described not as a villain, but as a prisoner of his own industry. He must show short-term results to keep his clients, which forces him to speculate on high-flying stocks rather than invest in deep value. The intelligent investor, therefore, must be wary. If he cannot pick his own stocks using the strict criteria, he should seek the sanctuary of index funds, or the closest equivalent in Graham's time. Closed-end funds trading at a discount. He should refuse to pay high fees for management that destroys value. The analysis here reveals the tyranny of costs. Every percentage point of fees is a percentage point of wealth transferred from you to the manager. Over a lifetime, this transfer is catastrophic. The lesson is cost minimalism. The narrative momentum shifts to the psychology of the bull market. Graham warns that the greatest enemy of the investor is not the bear market, but the bull market. It is in the euphoria of the rise that the seeds of destruction are planted. The archetypal, foolish winner makes money in a bull market and mistakes his luck for genius. He becomes overconfident, abandons his margin of safety, and begins to speculate on margin. He believes the new era propaganda. Graham writes with the gravity of a funeral director. The investor's chief problem, and even his worst enemy, is likely to be himself. The intelligent investor uses the bull market to sell, not to buy. He trims his winners and rebalances into bonds. He prepares for the winter while the sun is shining. This is the discipline of the ant, in a world of grasshoppers. The sensation of selling when everyone else is buying is painful. It feels like leaving a party just as the music gets loud. But it is the only way to ensure you are not the one cleaning up the mess when the party ends. The second 10,000 characters have taken us into the mechanics of the craft. We have moved from the philosophy of Mr. Market to the checklist of the Guardian. We have seen the net scavenger hunting in the ruins and the defensive investor building his fortress of blue chips. We have learned that risk is not a wiggly line on a chart, but the danger of being wrong without a buffer. The air is thick with the realization that investing is not about beating the guy next to you. It is about controlling the guy inside you. The path is set, the tools are sharpened, and the seeker is now ready for the final integration of these principles into a life philosophy. The story of the intelligent investor is not just about making money, it is about achieving a state of financial serenity that allows one to live a good life, unburdened by the terror of poverty or the madness of greed. The journey continues, intensifying toward the ultimate conclusion. The margin of safety is not just a number, it is a worldview. Results change when you change your perspective. The final movement of this financial odyssey brings the seeker to the sanctuary of the mechanical mind, where the chaotic storms of the market are tamed not by prophecy, but by the relentless rhythm of formula investing. We are overlooking the most important thing. The investor's greatest enemy is his own urge to make decisions. Every time you decide to buy or sell, you invite the demons of fear and greed to the table. Benjamin Graham offers a sensational antidote: dollar cost averaging. This is the archetype of the relentless accumulator. Imagine a man who buys $50 worth of a stock index every single month, regardless of the weather on Wall Street. When the market crashes and the headlines scream, apocalypse, his $50 buys more shares. When the market soars and the headlines scream, new era, his $50 buys fewer shares. He does not think, he executes. The analysis of this strategy reveals a mathematical miracle. By investing the same amount of money at regular intervals, the investor automatically buys more when prices are low and less when prices are high. His average cost per share ends up being lower than the average price of the market. This is the sensation of automatic victory. The psychological lesson is the removal of the burden of timing. The intelligent investor stops asking, "Is now the right time to buy?" and simply answers, "It is always the time to buy." The narrative intensity builds as Graham addresses the relationship between the shareholder and the management. In the modern corporate structure, a strange perversion has occurred. The owners, shareholders, act like sheep, and the employees, management, act like kings. Graham calls for the archetype of the sovereign owner. The intelligent investor realizes that the CEO works for him, not the other way around. He reads the proxy statements with the scrutiny of a detective. He demands that management return cash to shareholders if they cannot invest it profitably. He votes against exorbitant executive pay. This is the sensation of corporate democracy. The psychological depth of this stage is the rejection of passivity. Most investors treat a stock certificate like a lottery ticket, a piece of paper that might go up. Graham treats it like a title deed. If the management is destroying the value of his property, he does not just sell the stock, he fights for change or joins with others to demand accountability. The lesson is that ownership carries responsibility. You cannot claim the profits of capitalism if you refuse to perform the duties of a capitalist. The story flows into the parable of the Great Atlantic and Pacific Tea Company, A&P. Graham uses this historical giant to illustrate the manic depression of the market over decades. In one era, the market valued A&P as if it were going to own the world. A few years later, facing temporary headwinds, the market priced it as if it were going out of business. The intelligent investor, who bought when Mr. Market was depressed and held on, saw his wealth multiply. Not because the business changed dramatically, but because the asterisk perception of the business eventually aligned with reality. This analyzes the law of convergence. In the short run, the market is a voting machine, swayed by the popularity contest of the moment. In the long run, it is a weighing machine, and the gravity of real earnings eventually pulls the price to the true value. The seeker learns that patience is not passive, it is active waiting. It is the aggressive act of holding your ground when the entire world is telling you to move. The momentum carries us to the Magna Carta of value investing, the legendary Chapter 20. Here, Graham distills his entire philosophy into a single, sensational sentence. Asterisk investment is most intelligent when it is most businesslike. Asterisk asterisk. This is the archetype of the business analyst. The seeker must stop viewing Wall Street as a unique universe with its own mystical rules. Investing is simply business. Graham lays out the 4 principles of businesslike investing. First, know what you are doing, know your business. Second, do not let anyone else run your business unless you can supervise them, watch your managers and funds. Third, do not enter an operation unless a reliable calculation shows a fair chance to yield a reasonable profit, never buy on optimism alone. And fourth, have the courage of your knowledge and experience. This is the sensation of intellectual independence. If you have formed a conclusion from the facts and you know your judgment is sound, act on it, even if others hesitate or differ. The crowd is not right because they are many, you are right because your data and reasoning are right. The narrative reaches its climax in the fusion of character and calculus. Graham reveals that the margin of safety is not just an arithmetic concept, it is a life philosophy. It is the refusal to live on the edge. It is the wisdom of the engineer who builds a backup generator, the captain who carries extra lifeboats, and the investor who holds cash for the crash. The archetypal, intelligent investor is a person who has made peace with uncertainty. He knows he cannot predict the black swans, the wars, or the inflations, so he builds a portfolio that can survive them. This is the sensation of anti-fragility. While the speculator is fragile, needing everything to go right to succeed, the investor is robust. He can be wrong about the direction of interest rates, wrong about the GDP growth, and still retire wealthy because he bought assets so cheap that they had a buffer of reality built into the price. The psychological analysis reveals that wealth is the transfer of patience. The stock market is a device for transferring money from the active to the patient. The final revelation is the paradox of the professional. Graham warns that the more professional Wall Street becomes, the harder it is to beat the market. As thousands of smart people compete to find undervalued stocks, the inefficiencies disappear. This forces the intelligent investor to look where the professionals cannot go, to the small companies. The boring industries, the ugly stocks that fund managers are embarrassed to own. The seeker realizes that his greatest advantage is his obscurity. He does not have to report quarterly performance to clients. He does not have to worry about career risk. He can buy a stock and hold it for 10 years without caring if it drops 50% in the interim. This is the sovereignty of the individual. The professional manager is a slave to the benchmark. The private investor is a free man. The journey concludes with the legacy of the intelligent investor. We see the lineage of those who followed this certain way: Warren Buffett, Walter Schloss, Seth Klarman. They did not win by having faster computers or better algorithms, they won by having better temperament. They were the Stoics of the street. They understood that the market is a servant, not a master. They knew that price is what you pay, but value is what you get. The story ends not with a ticker tape parade, but with the quiet satisfaction of a man sitting in a study, reading an annual report, finding $1 selling for 50 cents, and having the discipline to buy it and the patience to wait. The intelligent investor is not a title you earn, it is a character you forge. Analyze the ultimate meaning that the book intends to convey. Asterisk. The intelligent investor is a manifesto for character-based wealth. Asterisk. Benjamin Graham's core message is that to invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. The book serves as a psychological shield against the madness of the crowd. It teaches that the market is a pendulum that swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes them too cheap. The intelligent investor is a realist who sells to the optimists and buys from the pessimists. The final lesson is one of emotional discipline. You are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. The climax of this journey leads to a state of financial stoicism. The seeker moves from the anxiety of prediction to the confidence of protection. They realize that the margin of safety is the only bridge strong enough to carry their dreams across the chasm of an uncertain future. The sensation of sleeping well at night becomes more valuable than the thrill of the gamble. The final revelation is that the stock market is a great humiliator of the arrogant, but a generous provider to the humble. The journey ends with the realization that the greatest risk was never in the stock market, it was in the mirror. You are the master of your own sanctuary, and the gold of that sanctuary is the discipline you have maintained while the world around you lost its head. To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks.